Welcome to today's webinar, courtesy of the Kentucky Small Business Development Center in Louisville. Discover no-cost, valuable business services to help you thrive, whether starting your entrepreneurial journey or scaling your existing business. We have the resources and expertise to help you succeed. For more information, please visit our website or text 502-977-5800. Thank you for joining us today. Feel free to use the chat feature to ask questions or engage with our speaker. Let's get started.
Hey, welcome everyone. Welcome to another Toolkit Tuesday. So glad to have you here, guys, here tonight. Thanks, as always, for taking time out of your day to join us. As always, I'm joined by my good friend and coworker, Janet Flo. How are you tonight, Janet?
Good. It's the evening edition. We're so excited.
Yes. We're going to try to do this from now on about once a month. So stay tuned. We'll see how it goes. And before I introduce our speaker, I'd like to make sure you guys can see and hear us. If you look at the bottom of your screen, you should be able to see the chat feature there in the toolbar. If you would mind, just click on that and say hello. Tell us where you're joining from. Just so I know you're out there. I can see some folks kind of popping in. And there's Janet, Nicholas, Dr. JC. Got a few more popping in. There we go. Good to see everybody. Yeah. All right. David. Hey, David. All right. Anyway, thanks for joining us. We at the Small Business Development Center, we are keen on helping you kind of or grow your business, start your business. We're always looking for strategies to help. And so we invited our good friend and also co-SBDC co-worker here, but he has a ton of strategies that you can use to improve your business. And it reminds me of a cool story, just to digress, about the UK, the England, British, I better say British instead of UK, bicycling team that never won the Tour de France. And they had a strategy of looking for 1% increases in different strategies. They didn't want to go all out. They just tried to improve tiny little things. And over time, they won several in a row. And so with that in mind, I think this is one of those things where, these small strategies, they add up to an overall positive effect on your business. So a good friend, Dr. J.C. Phelps, who is an expert in these sort of things. He is a great resource for all of us. So, Doctor, I'm going to let you tell a little bit more about yourself, but it's great to have you as always. Good to see you.
Thank you. Good to see y'all. Thank you for being here on this Tuesday evening. You can maybe tell I'm on my screened-in porch. It's an awfully nice day. So why
Yeah.
work inside if you can work outside, right? All of that to say, happy to be here. My name is JC Phelps. I have been here at the SBDC going on 7 years now, but I work out of our state office as their statewide training coordinator. I'm a small business owner myself, and when I'm not doing those things, I'm a professor of econ and finance. So I talk finance some days all day long. This is what I love. And occasionally a marketing class every now and then get crazy. But I'll go ahead and share my slides and we
Okay.
will get started.
Yeah. And if you have any questions or comments, just put them in the chat there and we'll get to them. And this is a really good opportunity to ask specific questions about your specific situation with a great expert. So keep that in mind as we go through this today.
Appreciate it. Thank you, Dave and Janet, for having me. I always enjoy it. I always like to just take a second and tell you all a little bit about the SBDC. This map actually needs a little updating now that I look at it, but all of that to say, what I want you to know about the SBDC is that we are statewide. I saw a lot of people in the Louisville region. I think I saw LaGrange, maybe Benton, Kentucky, but we do have centers all around the state that serve our region. The Moorhead region is I'm now a part of the Eastern Kentucky region. But all of that to say, no matter where you are in the 120 counties, we're here to serve you. The SBDC program offers two services. Our main service is what we call business coaching. That's when we work with you one-on-one, and we'd be very happy to do so. And then we also offer training and education like we're doing here tonight. And our Louisville Center certainly leads that, and I am grateful. As I said, I am JC, and you can see my email address there at the bottom. It's just my name, jc.phelps at uky.edu. Always feel free to reach out if you have a question. Would love to hear from you. I will send these slides to Janet, and she'll forward them to you for attending, and so you'll have my contact. But please know that I'm here to be of resource for you. I'm also very proud of myself looking at this photo. I have a great, I don't know, liking of wearing that same shirt when I do training. So I'm very proud to announce that the glasses are the same and I need that haircut, but I am wearing a different polo. I've done that a lot lately. All of that to say, I think tonight's topic could not be more important. And finance, if you were to talk to our average client, and when I was a business coach, I worked with many of them. And if you were to talk to the average business owner, what they would tell you that they struggle with in many ways is finance. And sometimes people struggle with finance and they may not even be aware. As I mentioned, my background is in finance. I teach finance on the undergraduate and the graduate level. But even when I'm teaching it on the graduate level, what I have always told my students is that finance is not rocket science. And I think part of the issue is that we overcomplicate it at times. And I think it goes into math phobia. People are scared of math. And I think it just goes into it's a topic that people freeze at. And so, what I hope tonight that I can provide to you are some practical strategies. I believe in the practical, actually, things that you can do that make a difference. And as Dave said, I couldn't agree more. Small things, eventually snowball into something large. And so you may feel as if you're making a small change, but if you add a bunch of those together, we're talking business at that point, right? We're talking some significant change to your finances, to your cash flow, etc. All of that to say, I always like to tell you, what are we going to do today? We are going to talk about the P&L in a great way, which is the profit and loss statement. Okay. We are going to talk about some high impact areas that detract from profit and how we can change them to help boost profit. And then I'm going to give you some practical take home tips that look at things like hidden costs, ways that we increase what's called CLV, customer lifetime value, and essentially how we can increase our cash flow without increasing debt. Because, if you get a loan, for example, and you have an onset of cash, that's a positive cash flow with the knowledge that we're going to have to pay that thing off, right? And you'll be spending money as you amortize the loan. All of that to say, financial statements, yes, I love them, and I want you to love them too. But I recognize that you might not. But financial statements matter. I always like to have a burden of proof if you've been to one of my trainings before. Financial statements matter because profit is not about making more sales. Case in point, that's not it. It's about managing the processes from top to bottom and altering the amount that you keep. The thing about a financial statement, and you'll hear me say this, and I say this to all my students, is that financial statements are like books. It's like a storybook. That's all it is. And it tells you what the business has done. And it will ultimately, if you're analytical with it, and again, we're here to help you at the SBDC, it will help you reveal some opportunities and some risk points that you need to take note of. And so, a practical tip, this is one of the things that really kills me. Financial statements are often done when someone's trying to get a loan, right? They do financial projections. But then people start operating a business and they don't worry about the financials. And then they wonder why things are going wrong. Now, it takes more time, really, maybe than 30 minutes to put together forms. But once you have a process, it can be automated, via your software. And we'll talk about that to an extent. But you should always schedule a little bit of time each month to look at your profit and loss statement and do a comparative look. What did it do compared to your budget? What did it do compared to your goals? Because we have to benchmark where you're at. A profit and loss statement, though, has a very simple anatomy. And it's not science, thank goodness, because I couldn't teach you that. But a profit and loss statement looks at what you brought in, what it cost you to make those sales, and what you spent. It really is, no more difficult than that, ending with what you're left with. But what we're going to focus on are expense categories. We're going to focus on gross profit. We're going to focus on operating income. We're going to focus on what's eating at that bottom line. And there are many templates online, that you could use. Maybe use accounting software that, can generate this for you. Wave, maybe use a QuickBooks, just depends. Maybe use an Excel sheet, whatever it may be. Your business needs an ongoing profit and loss. You need to know what actually happened, and you need to be thinking about your projections. Maybe you do quarterly projections or whatever it may be for your business. We're going to go through this very simple case, okay? All of that to say, this is grossly simplified. True financial statements are very long, and they should be in detail. This is the first profit and loss statement that I teach my students and that I show here in many capacities at the SBDC as well, of a fictitious company, Clear Lake Sporting Goods. With that said, even though this is very condensed, what you're not seeing is a lot of line by line detail. All the major things are here, no question. You're just missing out, on some granular stuff. So I would say to you, the more line items you have, if they are truly helpful and they need to be segmented, do it. I'm all for segmentation because I like detail. All of that to say, what we have here is a prior year and a current year. So this is a comparative between 2 years, first and foremost. And at the top, this says an income statement. By the way, that's the same thing, an income statement, a P&L, a profit and loss, all that's the same. But as I mentioned to you, reading a financial statement is nothing more than reading a story. It really isn't. So for example, we'll go through this line by line. But if I'm looking at current year, I initially sold $126,000 worth of goods and or services. However, let's say there were $6,000 in returns. That led me to a net sales of 120. Okay. To sell those goods, I faced costs, right? Whether it be inventory, acquisition, whatever it may be. And that's what's called your COGS, your cost of goods sold. That was 60,000. So now my 120 is already down to 60. You had, these are pretty cheap, but you had some rent, 5,500, some depreciation expense, 3,600, some salary expense, 5,400, utility expense, 2,500. Okay, now we're down to 43K. Then you paid some interest, you paid some income tax, whatever that may be. By the way, tomorrow's April 15th. Hope you haven't forgotten. That led me to a net income of $35,000. Okay. Net income is, of course, when that bottom number is positive, and a net loss being that it's negative. But a business needs to hit, a profitable amount. If a business just loses over and over at some time, I would question you, is it a business or is it a money-sinking hobby, right? In reality. But this is fictional. Growth is good. This business saw growth. You can see if I look at net sales, 100,000 to 120, gross sales 105 to 126. So this business is growing year over year. However, growth is only good if it's truly profitable, and we'll look at that. So the practical side of this is that you need to compare year over year data, quarter over quarter. It's not just about a one-time number. That's not going to do you much good because then you're only getting a part of the story. Okay. Net sales growth. Now, as I mentioned, net sales in this example, and maybe in your business, you went from 100,000 to 120,000. It's a 20% growth, right? 20,000 more, and we started at a base of 100. But the question is, how profitable were those? If I look at bottom net income, looking at your profit, we went from 30 to 35. So I did profit more, 5,000 more, in fact. And so if I think a $5,000 increase from 30, that would be 1/6. So, say, what would that be? 16 point something percent. So not quite 20, but pretty close, right? We saw more profit for sure. The tip here, if you're going to take your net sales number to be higher, which who doesn't want more sales? There's other strategies. You need to think about things like upselling. You need to think about things about like bundling. The answer is not just discounting. People often think, I need to discount my good so I will sell more of it. Well, as an economist, I would tell you, yes, that's true. That's the law of demand. But what I would also tell you is that also means that you're going to have to sell more quantity of goods to get to that point on a per item basis because you're not selling it for as much. But that doesn't mean your cost of goods sold is going down, right? It just means that you're taking home less per unit. That's not always the answer. So let's talk in the gross profit cost of goods sold little region there, okay? Cost of goods sold is really a stinker because we obviously live in an economy with inflation. Inflation affects us all differently and it affects businesses differently. But the rising costs that you experience, or even if you go down, past cost of goods sold, you have salary expense, rising costs there really, really hurts. But if you're thinking of just your inputs and your cost of goods sold, your profit's being eaten away. Okay. So all of that to say, if your cost of goods sold is going up and up and up and up, the question you have to ask yourself is, am I using the right supplier? Shop that around. Maybe you shop it once a year, right? Small savings on cost of goods sold makes a big difference in the bottom line. And it makes a big difference because that cost of goods sold is going to be on a per unit basis. If you are a business that's at scale, right, it's going to make a huge difference. And if you are not increasing your prices in accordance to your COGS, you're going to be taking home less per unit. But then you also have to ask yourself, is that increase in price justified for my consumers? Or are you going to price them out? That's the bigger question here. So that's why we got to watch that on a super, super granular level. That brings us to cost of goods sold. Let's just talk about it. Because some people, you hear COGS all the time. You may not know what that means. Maybe it's raw materials, right? You're a restaurant owner. It's the ingredients that go in your dishes. We know that food expense has obviously gone way up in our everyday household. It's certainly gone up on the restaurant basis, and restaurant margins are tight anyway. It can be purchased inventory or resell products. It can be things like packaging materials. It can be things like the freight in or the shipping costs for your materials or inventory. It can be things like storage or warehousing for inventory, tools and equipment, maintenance on your production equipment to keep that thing going. Now, here's the thing. I want to call this out. I I am a betting person, and I would bet on this pretty strongly. The average business does not fully equate or fully quantify their cost of goods sold. They may know what it costs to buy their inventory. They may know what it costs to buy their raw materials because they're paying an invoice. It is deeper than that if you're actually doing it correctly. Do you truly know your packaging expense? Boy, that has really gone up. Do you really know your shipping expense? Boy, that's really gone up. Is something that you're shipping in, is that facing, say, a tariff? Is that being included, right? so many things. Do you know your storage costs? These things matter. All of this together is your cost of goods sold. And so what often happens is that that is underestimated. And then you begin to question, well, where's my money? And you're seeing it's essentially think about a pool, right? You put in a pool in your house, and I walk by it with a little needle and I poke a hole in it around here and there. Water's going to ever so slowly come out. It might not gush out, but water's going to drain. Then you're going to walk out of there one day and be like, hey, where's my pool? That's just like your money. It's no different than that. Let's think about expenses. If I look at your expense management now, operating expenses here, wow, they're simplified, but they're just for talking points. Rent expense, if let's look at current year, 5,500. Depreciation, 36. Salary, 54. Utility expense, 25. Okay. What is true here, if I look year over year, is that my expenses, let's see, I did list appreciation. Make the rate expenses are listed for banks. Is it net income? So that's a great question, David. So again, one I will say this is a simplified, but operating income, what I how I tend to think is that interest and income tax expense, I call those double I's. Those double I's come out after operating income, generally speaking. Now, with that said, I see where you're going with that. It does all come out and ends at net income. This is a minus, 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 which is why you're not necessarily seeing brackets. You may choose and want stylistically to have brackets, which tend to mean subtractions. But all of that to say, since everything is subtracted on the form, that's why there's not a bracket, right? It's assumed. Whereas if you have mix, say on a cash flow statement where you have inflows and outflows, it's not. What I would tell you is that at the end of the day, I do think placement matters. And I think placement matters, especially because when these become more granular and say this becomes a multi-page document, you're going to want it in the right place. And so on a simplified level like this, it looks less important. And I'm with you on that, but placement is critical for sure. Great question. Appreciate you. Now, the fixed costs here, and I'll talk about depreciation in a coming slide, coming soon. Fixed costs here went up, right? Think about what are my fixed costs. Rent expense went up by 10%, 5,000 to 5,500. Was that justified? Now, may or may not have been. Are you in the right place? Now, 5,500, if that's an annual rent, right? That's pretty cheap. But just roll with me here. Maybe it went up by thousands. Was that justified? Is something negotiable? Is the raise negotiable where it can be, commuted to a certain percentage? Hire smarter, not more. Now that's getting into salary expense. We're talking about fixed expenses here. Salary, or excuse me, labor expense can often be um, variable because if you're paying someone by the hour, that's a variable cost. It's also true. You need to be watching that. However, we're going off salary here. So, for example, if you're looking at this document, this could be, say, listed in tens of thousands of dollars, right? Or in thousands of dollars, which would make these numbers bigger. If it was in thousands, salaries would be, 5,400,000. If it were in hundreds, we would add two more zeros. It would be 540, etc. But all of that to say, hiring more people is not always the answer, right? We have to think about what's called the marginal fiscal product of an employee and ask ourselves, how much are they actually contributing? Sometimes we think that's how we need to grow. Not always. That eats at the bottom. Are there things that you can do to reduce utility expense if you have something that's a really an energy sucker, right? Something that's idle. These small things do make a difference depending on your scale. Depreciation. Now, depreciation increased here. If depreciation's increasing, assuming that you're doing straight line on things, are you having a new investment, right? Something else is depreciating. And that question would then, beg the question that you should ask yourself, did that investment lead to more profit, right? Did it lead to more profit? Said differently, some people love to buy things to buy things. And that is not necessarily the move. Sometimes we want what's shiny, but if that thing is not, it's not increasing your revenue in a huge way, we got a problem, right? And all of that to say depreciation is considered an operating expense because this is a cost of using a long-term asset in normal business operations, if you want to think about it that way. So we're matching costs to revenues. And so you could say, it's say a cost associated with asset usage, machinery, delivery trucks, whatever it may be. What I want to point out here is that it's this philosophy. Now, if you've ever watched Schitt's Creek, I always think of the show when I say this. But one thing I want businesses and I want you all to kind of defeat in your mind is this philosophy of, well, it's a write-off, right? It's a write-off that encourages so many people to make some sort of capital outlay, some sort of expenditure that simply is not justified always, right? I'm getting a laugh, so someone knows my reference. Write-offs are not one for one, and that doesn't mean that the investment should be made. Is it a business expense? But of course, right? That said, it's not so cut and dry. And so if that's your mentality, I really encourage you to reconsider that because both your cash flow and your profitability are going to be greatly hurt in the future. Okay. Excuse me, operating income. So if you look at the overall profit and loss structure, which is very commuted here, but we have the big. We start with gross sales. We know in some businesses, some things are returned. That's why we have a net sales with costs, with the sales returns and allowances coming out. If you take out your cost of goods sold, that's called your gross profit. That's not your profit, that's your gross profit. You take out all the expenses that are associated with operation, and that's your operating income. Okay. So your operating income is your profit from operations. This is prior to financing and it's prior to taxes. And so going back to the question that you asked, David, that's why those are listed below. What I call the double O's. That's how I tend to remember it. But this is prior to operation. And so here's a tip. And boy, if only it were this easy. If you're thinking about efficiency in the business, true financial efficiency, it is an amazing goal to aim to grow your operating income faster than sales. Okay. Now we're talking. If your sales go up 10%, but your operating income goes up 14, okay. Now we're talking. That's good. 12%, 16, who knows? There can be different margins. Maybe it's 10 and 30. I've had students and I've had clients over the years like say, well, how is that even possible? It's possible if we're adding, generating revenue, but also being lean in the in between, right? And we're not, spending or adding expenditure in the amount of our sales increase. That is one way to make a dramatic difference. People, I think, don't look enough at operating income, and so I encourage you to do so. But let's talk about some cash flow strategies. Okay, now this is kind of overall. I do just want to call out here. We're talking about the P&L, right? P&L, that's the storybook that we've looked at right here. How did I start with 126 and how did I end up at 35? How in the year prior did I start with 105 and I ended up with 30, right? How did I have a 30% profit margin and then the profit margin in the next year? Okay. A profit margin, for example, one of the main things calculated from this is looking at your sales, relating that to your net income, and saying how many cents of every dollar that you bring in sales is profit. So again, I remind you, the goal is not let's have more sales. Yes, that should be a goal. Let's bring in more sales. But true financial skill is saying, how do I retain more pennies on the dollar of every dollar that comes in? If you can do that and you can make more sales, Now we're talking major profitability spikes. But as I've mentioned, I really think the pool analogy with like a needle is the best way to think. Each of these line items are little sucks and it takes it out, right? Let's talk about some cash flow strategies. So I'll tell you, this slide when I first made it was inspired by actually a TikTok video that I saw, where, and I love this, people will ask, um, they'll ask like, how many subscriptions do you have? And I actually talked about this on Wallet Nerd not that long ago in an article. But in business, we often subscribe to things where we think, oh, that's going to be very helpful to me. If you're not using something, that's an expense that you probably have recurring on a monthly, worst case scenario, if it's an app, maybe it's a weekly basis. That's a cash flow suck. That's an expense that you don't have to have. Okay. If we're thinking about how do I get more cash coming in? How do I increase sales? I want you again to think about bundling because it is let me rephrase. We can always get new customers. We need new customers. It is expensive if you think about the overall financial outlay of getting new customers. So it's also not the solution just to say, I need more people sitting in my chairs in my restaurant. The consideration should also be I need each person that's sitting at a chair in my restaurant to spend more money. Why do they charge $3.50 for a fountain drink? Why do they push appetizers and desserts? This is the restaurant model. This is also true in whatever business model you have. How can you bundle? How can you add a dessert to whatever you're doing? Your average order value goes up, right? With other expenses going up potentially nominally with that. If you're having money come in, maybe you offer a discount for fuller upfront payments. I don't think you should always offer a discount, but let's say you have like a large scale, cash flow coming in where traditionally you would be at net 30, net 60, net 90. There can be a time and place to offer a discount to get that cash in because it may save you, say, some interest expense in the future if it keeps you from taking a loan. That doesn't mean that you should always offer a discount for paying early or full. No, by no means. It's a case by case basis. All of this is case by case. Again, look at your vendors and suppliers, renegotiate with them. How do you improve your cash flow immediately? Again, I stress upfront pay. If you can get your money in your pocket faster, you're good. Now, I'll tell you, and maybe I'm speaking a little bit from personal experience here. My main source of business income in what I do is net 60. Brutal. 2 months. Takes me 2 months to get it. I get money every month, but if I'm getting money in April, I'm getting 2 months ago that money that I made. But if you get your money in sooner, you can reinvest it sooner. Maybe it's in inventory, maybe it's in marketing, maybe it's in operations. This will help grow revenue if you use those things effectively. These will also reduce potentially your need for financing, maybe your reliance on a line of credit. That also increases your profitability, right? Because you're not having to have that outlay with interest. If you can avoid the need for loans, and there's a time and place for debt, and many businesses acquire debt at many points of their business. So I'm not shaming debt. But if you have some better cash flow, you can have better profitability because you're going to be less dependent on things like a credit card and accruing 20 something percent interest. Talk about an expense suck, right? That's going to eat your profitability. Or maybe a high interest loan to cover a gap or a line of credit. This is a long run strategy, but this does increase net income. What's something that's eating your net income? If you have a high credit card balance, boy, that's one of them. It's really hard to invest your money in a way that's going to make you more money than you're paying in interest on a credit card. That's for sure. It could be 27%. Who knows? Depending on your terms, and you should know your terms. Reducing the risk of non-payment. That's another benefit of trying to get your money. People that do not satisfy their payment is a huge risk to you. People may pay late, people may not pay at all, right? And so again, getting better about upfront payment secures the sale. I'll never forget a business that I contracted with multiple times throughout the time of my business, and when they were open, they had a significant invoice out on me, a 5-digit invoice, a big one. And I waited and I waited and I thought, where's my money? I followed up and I followed up and I followed up. I eventually then had to retain an attorney, which cost me money, to then be notified that they had filed for Chapter 11 bankruptcy. And as a non-secured creditor, of course, I'm falling short on the repayment. Even though they owed me tens and tens and tens of thousands of dollars, the offer was essentially, if I pursued it, I could get like 2 to 3 pennies on the dollar. That was a very huge expense for me, right? Because I was waiting on that money to come in, and I had to secure a lawyer, and I was without that cash flow. That absolutely affected my P&L. So I want you to think about your payment terms. Sometimes we're too nice, if you will, and different things work for different people. My net 60 term works for me. It's standard. It's consistent. It's reliable. It's all good. But I wouldn't do that for every source of my revenue, right? What are some other profit strategies? Think about price raising, okay? You can't just raise the price on everything. That's not how it works. That's not how we do price increases. But think about the things that are maybe best selling. Maybe think about the things that are highest margin. This is a good place to start looking. Highest margin, your margin's only going to be higher, right? Best selling, the word to describe this is actually inelasticity. If I feel that my customer is still going to pay whatever price it is for the good, if I just inch it up a little bit, it's one way to increase that top dollar, and hopefully that translates to a bottom dollar increase too. Do you have an HR problem? And boy, let me tell you, a lot of businesses do. I can't help myself. When I'm sitting in a restaurant or sitting in a business, I can't help but to be scanning and thinking about labor and efficiency. Happens all the time. Do you need to look at optimizing schedules, cross-training people? That is going to make you more profitable. Can you improve inventory turnover to avoid either overstocking and or storage costs? Inventory turnover, if you're not familiar, is calculated from your COGS divided by your average inventory value, and it measures how many times your inventory is sold per year. We want to improve that, obviously, because we want to sell through our stuff. But if we're not selling through it quick enough, you may have overstocked, or you may have a lot of storage expense. Taking a spot on your sales floor, for an example, is eating at your profit margin, because we want things to come in and we want things to go out. And lastly, think about repeat customers. Think about loyalty offers. Think about ways that we can get people in and get them to transact with you 6 times a year instead of 4, monthly instead of every other month, right? These are the types of things I want your mind to be thinking about. Okay. Almost done here. A few more. Maybe you look at outsourcing. Is there something you could outsource to control labor costs? I have done this in the last few years to my own business. I'd never done this. And what a lifesaver. Maybe the right thing for you, may not be. Profit strategies, you got to watch the statement, right? I've got to keep saying it. It's repeated on purpose, because you got to set a profit goal and you got to see what's taking it out. One thing I want to say, because I do a lot of marketing consulting, and my business and career has largely been in marketing, is that you need to be tracking the return on things. If you are spending money on something that's, marketing, for example, whether it be a social media ad, an SEM ad, some sort of PPC campaign, you need to know what the return is. Now, I will say this is easier said than done, depending on the type of marketing. For example, I live in Louisville too, like most of you all. And every year I sponsor Germantown baseball. I live in the neighborhood. Do I think that that necessarily returns for what I do very specifically? I know it doesn't. That's kind of a feel-good thing, but that's detracting from my profitability, right? That's something you got to think about. But all of that to say, if you're looking at your marketing initiatives, what can you cut that's underperforming, right? And something may be underperforming that you think is performing at the rate that you desire if you're not looking close enough. And how do I then reinvest or divert that expenditure into something that is performing well and or preferably overperforming? Yeah. Just a couple more slides and I'm seeing your questions. We got some good ones. Low stock alerts. Stock and inventory is a huge expense. It can really eat at your profitability if you're having to make last minute premium purchases, if you don't have to buy things in bulk, if you're having to buy things not in bulk, if you're having to pay overnight shipping, boy, oh boy, does that increase your costs. And those costs are usually eaten by you. They are not reflected to the customer often. Things that you should know in your business, reorder point, ROP, that's a calculation. When should you reorder? An EOQ, that's an economic order quantity. How much should you reorder? These are mathematical concepts that are pretty important. How much should I reorder? Meaning, how much do I need, on the floor or in the back? And when should I reorder it? At what point, right? If you at minimum look at your costs annually, now what you don't want to do is nickel and dime your people. Pricing is psychological. But again, you may think about, whether you need to increase the price with a set regularity. Maybe it's annual, right? You look at cost changes. You look at what competitors are doing, and you can gauge that. You don't want to increase your price every month, right? Or make everything market price, right? Who likes that? You don't know what you're going to be charged. And while it sounds so silly, businesses don't do it. Whether you are managing, say, operating expenses or other expenses that you may have, set a budget for yourself and say, okay, self, I have reached that. And instead of detracting from your bottom dollar over and over again, say, I am tapped out on my marketing this month, right? I'm tapped out. There's just nothing that you can do. Um, Sometimes you gotta cut yourself off in the in the air of protecting a protectionism of your profit. So practical takeaway, here's what I want you to think about at the end. Sometimes we think of profit as this like overarching reality. It seems like this fairy tale. It seems like something that's mystifying. It is not. Profiting is intentional. It does not happen by accident. And true profitability and growth in profitability is not from increasing sales alone. It's not from, doing anything singularly, ceteris paribus. What it is it's through good management. Looking at the granular, looking at the line by line. Can I get more lean here? Is this money returning me, having return on investment there? What is this actually producing for me? Do I have one too many people on the floor? Do I need to look at a new supplier? Et cetera, et cetera. It is a huge task to do. But if you set a schedule, maybe isn't the word I'm thinking about, but if you set a regularity within the business where this becomes a task, just like putting the key in your door, now we're cooking, right? That's what we need to do. What business owners often do is that they make decisions based on guesses or what they feel like is their best guess of their number. That is erroneous. You need to make decisions based on real numbers. And the numbers can't be real if they're not detailed and if they're not tracked, right? Your income statement is a roadmap. It's a storybook. You read past performance. When I look at your projected, this is what I'm planning to do next quarter. That is a roadmap that you should be following. If you're trying to hit X dollars of profit between looking at your net sales and taking out your cost of goods sold to your gross, taking out your operating to your operating income. Planning those expenses is a roadmap, and it's one that you have to follow, or you very quickly turn into a situation where you're going to see a net loss. You very quickly have a bad cash flow situation where maybe your payment's not coming in due to payment terms, or you're not getting money in fast enough, yet you have all this money flowing out. That is taken into account on the cash flow statement. There are three main financial statements. We focused on the P&L here, but of course, there's the statement of cash flows. There's also the balance sheet, which looks at the interplay of your assets being equal to the sum of your liabilities and your owner's equity. Okay. Profit is required for business. Business cannot sustain itself. It's not feasible if you cannot profit. And so if you are going to be in the game, if you're going to be in business, you have to protect it like it matters, because quite literally it does. Without it, at some point, businesses will shutter. And that's not my wish for anyone. And it's certainly not my wish to you. My view is that being in business is tough, no question. And so, the exterior is going to be hard enough. If you can protect yourself on the interior in any way or capacity, please do so, because that's advocating for yourself and your bottom line. Okay. Little things make a big difference. Line by line, you make a change. I promise that bottom number change is going to be one that's going to be worth writing home about. Okay. I'm going to stop sharing and get in here to questions. Let me remove my pen. Let's see what we are rocking with, Dave.
Yeah, we do have some good questions today.
How fun. I love talking profit. Yay,
Yeah.
profit. Let's see. Thomas, how do you feel about a half and half income where you get 50% of the product and 50% cash on delivery rather than billing net 30, net 60? What do you think about that, Dave?
I think that's a wise move. Always accelerate payments when possible.
Absolutely.
And as, as you know, once people get whatever they want delivered, there's less incentive for them to actually pay, and so they're in no hurry. So, yeah,
Completely agree. Completely agree. Any acceleration is always a good thing.
yeah. I'm telling people these days, like the best way to test whether, if you're going to launch something new or try something new, if you can get people to pay you in advance, even before you do anything, that's validation. If they're willing, if they see the value, that's what you're doing is solving people's problems and providing them value. If they're willing to pay for what you're selling, even though you haven't delivered, then you have a valuable product right there.
Absolutely. Melissa says here, any ideas for finding someone to volunteer to do my marketing? So, Melissa, I don't know what it is that you do. Now, if you can find someone to volunteer for your marketing, that is going to be a profit, a net
Mhm.
income plus. With that said, marketing is quite expensive.
Yeah.
And it is absolutely something that if you are not capable of doing within your own wheelhouse, it is something that should be budgeted if it's something that the business is going to be involved in, and of course it should be. Now, with that said, let's see, you're a therapist that owns a group practice. We specialize in veterans and first responders. That's amazing, and that's a great service. So thank you for providing that. Number one. What I would tell you, my best advice, I say this as I'm currently running a capstone of 19 students who are working with clients. The only way I could think about, you getting truly a volunteer coming in is if you developed like an internship pipeline with, say, a business school, if you're in Louisville, say at the University of Louisville or at Spalding or at Bellarmine, every semester, like where I teach, I have 19, 20, 25 kids that are very talented on social media. They're young and they're fresh for experience. They want it. Um, and they get placed with someone. And so that's a very good thing. And it's a way for volunteership. But here's what you got to think about. That those type of situations also have very volatile turnover because it moves on to a next semester and say they're in a different class or they graduate and they get a job. And so if you could think about a partnership in that capacity, that might be one avenue for you to look into. But if you're looking for volunteering or in terms of free labor, you're probably thinking maybe in the undergraduate space. But they're pretty sharp on marketing, I'm not going to
Mm-hmm.
lie. That would be my advice, but my advice also would be to think about building marketing into the budget.
Yep, exactly. Um,
It's a great question. Appreciate you.
yeah. That being said, just piggybacking on that, let's just say you don't have a budget and you're getting started. I mean, where would you go first, JC? I mean, what would, there's, I think there's an idea, I think, as the business owner, as the first face of the business, so there's something, whether you feel yourself you are a marketer or not, there's a certain amount of marketing that you as the CEO has to do on a regular basis. So, um, what would be the first bit of advice you would give somebody, JC?
That's a great question. So, my first piece of advice, if you are trying to look into growing the business through marketing channels, is that first and foremost, and sometimes startup businesses don't have this down. Step one, we have to understand who is deriving the demand, actually, who's the customer, because sometimes we think the customer is X, but it's actually Y. We
Mhm.
have to understand that, because then when we have that, say, demographic information, we can place them into categories of saying this average consumer lives or primarily receives information on X platform. Then you could direct it that way. My opinion is as such. No marketing should be paid in the beginning. And so you should establish yourself on platforms with regularity, but it should just be posting. You should not be running ads. I mean, if you're having a launch campaign, I get that. But like if you're truly just trying to dip your toes in and understand, if you're at that stage, putting money behind a spend is probably not going to give you the ROI that you want, because you're not going to know how to optimize it. And you also won't have the data in the account to optimize the ads from. And
Mhm.
so my advice would be to start posting across platforms, see what's sticky, what's converting, what's getting more engagement. Focus more on that style of content. Then, when you have that down and you have a regularity, you then should feel a little more comfortable in putting an ad spend behind it. One thing I would also tell, everyone on here, I know we're talking about profiting, but this does lead back to profit in the long run. If you are not a marketer, that's cool, right? If you're not a finance person, boo, but cool, right? We all have our thing. But if you are the business owner, especially in a small business where our staffs are small, etc., you need to have knowledge in every aspect, because how can you manage someone, or how can you truly understand what your return on investment is if you don't actually know what they're doing? And so while it is a big burden of education per se, I think you need to have some cognizance there, to make sure you're spending your money in the right way if and when you hire it out. Does that make
Mhm.
sense?
Yeah. I would just add one thing you made me think of this is like in the beginning, I would, as a CEO, I would look at, are there referral partners out there that my clients could come from if I just introduce myself? So that's free. You would just have to make a call or send an email, and you do the direct one-on-one sales. And that's a hard thing to do for people. I have that problem too. I don't like doing that, but if you can do that, you can usually start generating some sales pretty quickly just by reaching out and telling people what you do and offering to help.
Absolutely.
Let's see what we got here. Robert, this question may be off subject. I think I was trained to be able to bid on larger projects that could bring in more revenue instead of cutting costs on smaller jobs. I'm in construction.
That is not off subject at all. I'll start,
Yeah.
Dave, and then if you want to come in.
Okay.
So, generally speaking, right? If we're thinking, let's think we're trying to get to a dollar. If we can get to a dollar in 4 quarters instead of 100 pennies, by all means, the efficiency is going to point towards the 4 quarters. And so that is absolutely true, with an asterisk. Sometimes large scale jobs, depending on the scale of your company, you have to ask yourself, are we positioned to transact at this scale? Sometimes people bid on contracts or they get something and then they have to contract people to come in with them to get the job done. So, what I would encourage you to think about, yes, it may still prove to be more profitable and or one way to get you to your point you want to be by doing something bigger, but you have to be granular there because big projects have a way of ticking up the expenses quite quickly. And so I would say absolutely true if the spread between what you're bringing in sales and the margin that you have while after taking out your expenses is there. But big projects can also return small amounts of money. And that's
Yeah.
true financially. What you would be looking at, if it's a multi-year thing, if say you're taking something on, you may be looking at what's called a net present value of a project. But all of that to say, it's true if it mathematically works out, but I have seen both, and both can happen. Small projects can be more annoying because you got to do more of them. However, if the margin is there, it just depends, right? You may can get through that job faster, and it may be a quantity thing. And so I don't think that's a one size fits all. But in
Mhm.
construction, I would certainly think that if you could manage expense, doing, fewer per se, but doing larger would likely position you the best.
Yeah. The other thing you have to think of is the cash timing, because on bigger projects, you'll have a lot of expenses going out and your
So
first
true.
scheduled draw could be 30 days, but you might not have the money to cover all that stuff. So you have to have the financing in place. Whereas smaller jobs, especially if they're residential, you can get paid today when you get done swinging your hammer, just whatever you set up. So it's a matter of what you can afford, what the financing you have in there. So I think it's important to do a little bit mix of both so you have like churn if you have the crews to do it.
Yeah, absolutely agree. That goes back to the net terms. You're
Yeah.
so welcome.
Mhm.
Let's see. Are you an SBDC coach? So I'm the training coordinator, so I no longer coach in the field. However, Davis
Yeah,
and
you're
Dave's
stuck with me. I'm sorry.
yeah, Dave is the center director in Louisville, and is, along with many other people in our network, so skilled in financials. I'll brag on Dave. He's at the top of that. So I would highly recommend working with Dave, working with people out of our Louisville office if you're in Louisville. But again, we do cover all 120 counties. And so our SBDC coaches are trained to help you through the different financial needs. We're not lenders, of course, but we certainly help people position themselves for lending, understanding their financial positioning, going through your financial statements, etc. I was in my past life an SBDC coach, though,
That's
but
right.
I rebranded, right, Dave?
That's right. You leveled up. That's what we say. You leveled up.
I'm not sure about that, but I rebranded. That's for sure.
Yeah. Yeah, we would be happy to help you. Just go to our website. It's KentuckySBDC.com/Louisville, and then you'll see all of us and just reach out. There's two other coaches here, but there's coaches all over the state. So if you're in a different area, you can pick a coach in your area if you want.
How many do we have, Dave? I should know. 20-ish? 20
Yeah,
business coaches? Does that sound
it's
about right?
a good guess. Yeah.
Yeah,
I've
ish.
never actually counted.
Yeah, me either. I really should know that.
I
I think
know.
it's around 20 though.
I know them when I see them. That's all I can say.
Yeah, me too. You're very welcome.
Yeah.
Appreciate you.
Well, this has been fantastic. We're at the top of the hour and I went by so fast.
Time flies when you're talking about profit.
That's right. And money. Well, thanks for joining us, everybody. It's been fantastic. And Janet, thanks for driving the ship as always.
Sure thing. Just to note, folks will be receiving an email with evaluation form. So fill that out for us. Thanks.
Yeah. And we'll send you the slides and the recording here in a day or so. So look for that. Don't miss it.
Thank you
All right.
much.
We'll see you next time. See you next Tuesday on another Toolkit Tuesday. Good night, everyone.
See y'all.